20 basis points for the 1 year ahead horizon. Merchandise exports contracted in June 2019. Imports also contracted. And as the fall in imports was larger than that of exports, the trade deficit declined modestly during May-June on a year-on-year basis. On the financing side, net foreign direct investment flows moderated to US $6.8 billion in April-May 2019 from $7.9 billion a year ago. Net foreign portfolio investment flows in the domestic capital market amounted to US $2.3 billion during the current financial year so far, that is up to 5th of August, as against net outflows of US $8.5 billion in the same period last year. India's foreign exchange reserves were at 429 billion US dollars on August 2nd, 2019, an increase of 16.1 billion over end March 2019. In view of these developments and considering that inflation for first quarter of 2019-20 was in alignment with its June projections, the MPC has retained its inflation projection at 3.1% for Q2 2019-20 and revised the projection for H2 2019-20 to 3.5% to 3.7% with 3.5% to 3.7% with risks evenly balanced, from 3.4 to 3.7% projected in June. CPI inflation for Q1 2021 has been projected at 3.6%. The MPC has revised downwards the projection of real GDP growth to 6.9% for 1920, and this consists of 5.8 to 6.6% for H1 1920 and 7.3 to 7.5% for H2, with risks somewhat tilted to the downside. This is against 7% which the MPC had projected in the earlier meeting in June. And at that time, the projection, as you would recall, was 6.4 to 6.7% for H1 and 7.2 to 7.5% for H2 of 1920, with risks evenly balanced. The downward adjustment in GDP growth projection was warranted by various high-frequency indicators pointing to weakening of both domestic and external demand conditions. On the other hand, the MPC was of the view that the impact of monetary policy easing since February 2019 is expected to support economic activity going forward. The MPC has voted for a policy rate reduction of 35 basis points instead of conventional 25 basis points. Let me explain the rationale underlying this action. Considering the evolving macroeconomic outlook, the Reserve Bank has been preemptive in its monetary policy actions and stance. Since February 2019, it has reduced the policy repo rate by a cumulative 75 basis points till today's meeting. In addition, it has changed the stance of policy from neutral to accommodative, which is effectively a further reduction in the policy rate since it takes rate increase off the table, while committing to either rate reductions or status quo going forward. Furthermore, sufficient liquidity has been provided to the system, resulting in overnight money market rates trading below the policy rate throughout July and August so far. In today's meeting, the MPC judged that with inflation projected to remain within target, addressing growth concerns by boosting aggregate demand, especially private investment, assumes the highest priority at this juncture. Against the backdrop of policy actions taken so far, the MPC felt that it is prudent to remain accommodative. While remaining consistent with inflation mandate, the MPC considered it necessary to calibrate the size of the policy repo rate cut to the dynamics of the situation. Accordingly, the MPC was of the view that the standard 25 basis points might prove to be inadequate in view of the evolving global and domestic macroeconomic developments. On the other hand, reducing policy repo rate, say by 50 basis points, might be excessive, especially after taking into account the actions already undertaken by the RBI. Reducing the policy repo rate by 35 basis points was therefore viewed as a balanced level of cut under the circumstances. Now I shall turn to some of the developmental and regulatory policy measures that we have announced today in the areas of financial markets, payment and settlement systems, banking regulation, financial inclusion, and credit flow to NBFCs. As regards financial markets, the Reserve Bank has been making continuous efforts to develop the market for state development loans, SDLs, in both primary and secondary markets. In continuation of these efforts, it has been decided to introduce stripping or reconstitution facility of SDLs, that is state development loans, in consultation with the state governments. In order to enhance efficiency and soundness of the payment and settlement systems, several measures are proposed. First, the National Electronic Funds Transfer (NEFT) payment system operated by the Reserve Bank as a retail payment system will be made available on 24/7 basis from December 2019. This is expected to revolutionize the retail payment system of the country. Second, all categories of billers except prepaid recharges who provide for recurring bill payments will be permitted to participate in the Bharat Bill Payment System (BBPS), an interoperable platform for repetitive bill payments on a voluntary basis. Apart from digitization of cash-based bill payments, these segments would also benefit from the standardized bill payment experience of customers, centralized customer grievance redressal mechanism, prescribed customer grievance fee, and the like. Third, it has been decided to enable diversification of risk and encourage innovation and competition by offering on-tap authorization to entities desirous to function, operate, or provide platforms for Bharat Bill Payment Operating Unit, Trade Receivable Discounting System, that is the trades, and white label ATMs. Fourth, the Reserve Bank will also facilitate the creation of a central payment fraud registry for tracking payment system frauds. Participants in payment systems will be provided access to this registry for near real-time fraud monitoring. This aggregated fraud data will be published to disseminate information on the emerging risks. In the area of banking regulation, it has been decided to reduce the risk weight for consumer credit, including personal loans, but excluding credit card receivables, to 100% from 125% or higher. Over the last 1 year, the Reserve Bank has taken several measures to enhance credit flow to the non-banking financial companies, NBFC sector. Now, the details of these are given in the Statement on Developmental and Regulatory Policies, which has been uploaded in our website, copies of which have also been shared with you. In continuation of these efforts, 2 more measures are now being announced. First, it has been decided to raise a bank's exposure to a single NBFC to 20% of Tier 1 capital of the bank as a step towards harmonization of the counterparty exposure limit to a single NBFC with that of the general limit. Second, in order to augment flow of credit to priority sectors that contribute significantly to exports and employment, it has been decided to allow bank lending to registered NBFCs other than MFIs for on-lending to agriculture. Agriculture means only for investment loans up to 10 lakhs, micro and small enterprises up to 20 lakhs, and housing up to 20 lakhs per borrower, as against 10 lakhs in the case of housing, which is at present. All these will now be classified as priority sector lending. It will be remiss of me not to address issues relating to monetary policy transmission and liquidity management, which have been flagged for prioritized focus in previous statements on developmental and regulatory policies. I also appreciate that market participants and analysts will be looking forward to development in these spheres. With regard to monetary policy transmission, it may be recalled that an easing cycle of monetary policy commenced in February 2019 with a cumulative reduction in the policy rate by 75 basis points during February to June. The stance of monetary policy was changed from neutral to accommodative in the month of June. These policy impulses have been transmitted through financial markets fully. I repeat, these policy impulses have been transmitted through financial markets fully. The weighted average call money rate, WACR, has declined by 78 basis points, market repo rate by 73 basis points, and 10-year benchmark GSEC yield by 102 basis points. Banks, on the other hand, have reduced their interest rates on fresh rupee loans by only 29 basis points so far during February to June. Our interactions with various stakeholders, including both public and private sector banks, indicate that steps are being taken by them on an ongoing basis to progressively lower their interest rates so that the benefits of policy rate reductions are passed on to the economy. Accordingly, we expect higher transmission of monetary policy action and stance by the banks in the weeks and months ahead. On liquidity management, the system has experienced large surplus conditions since June. The Reserve Bank absorbed liquidity of rupees 51,710 crore in June, 1,30,931 crore in July, and 2,11,140 crore in August up to August 5th on a daily net average basis under LAF. 2 OMO purchase auctions amounting to 27,500 crore were conducted in June, thereby injecting durable liquidity into the system. The weighted average call money rate, WACR, the operating target of monetary policy, was aligned with the policy repo rate in June, but it traded below the policy repo rate on a daily average basis by 14 basis points in July and 17 basis points in August so far. As announced in the Statement of Developmental and Regulatory Policies on June 6th, the Reserve Bank constituted an internal working group to comprehensively review the existing liquidity management framework. The group has reached an advanced stage in its deliberations and its recommendations will be available shortly for public comments. Meanwhile, the Reserve Bank has injected a substantial amount of liquidity into the system through combination of instruments including the LAF, open market operations, and forex swaps. There is an abundance of liquidity in the system currently, warranting absorption of surpluses by the Reserve Bank. Surplus liquidity parked in the reverse repo window of Reserve Bank was almost rupees 2 lakh crore on 6th of August. The Reserve Bank is committed to ensuring that sufficient liquidity is available so that the needs of all productive sectors of economy are met. Towards this objective, the Reserve Bank will use its liquidity management instruments to ensure that the system's requirements of both day-to-day liquidity and durable liquidity are adequately provided. Thank you.
गवर्नर, आपने ये जो 35 बेसिस पॉइंट का रेट कट किया है, दुनिया में शायद पहली बार है। आपने जब अपना भाषण दिया था, उसको मैं जहां तक याद करता हूं, आपने कहा था कि हम एक स्ट्रॉन्ग संकेत देना चाहते हैं। तो क्या ये संकेत है बैंक्स के लिए कि वो तेजी से रेट कट करें, और साथ ही क्या ये भी संकेत है कि आपके पास अब रेट कट करने की ज्यादा जगह है, तो आगे हम और ऐसे ही रेट कट्स देखेंगे?
जी, आगे क्या होगा वो इनकमिंग डेटा के ऊपर डिपेंड करेगा, उसके बारे में मैं अभी कोई इंडिकेशन देना नहीं चाहूंगा। लेकिन एग्जाम्पल्स आर देयर, प्रेसिडेंट्स है, ऐसे नहीं है। एडवांस्ड इकोनॉमीज में जब रेट कट किया हुआ है पहले, तब 10 to 15 बेसिस पॉइंट्स रेट कट्स किया हुआ है पहले। इंक्रीज साइकिल में शायद किसी ने 35 बेसिस पॉइंट या नॉट मल्टीपल्स ऑफ 25 बेसिस पॉइंट्स शायद किसी ने नहीं किया है। तो ये मैंने जैसे एक्सप्लेन किया, जो इवॉल्विंग इकोनॉमिक सिचुएशन है, जो हमारा ग्रोथ का जो एमपीसी का जो असेसमेंट है अबाउट डिमांड कंडीशंस, इन्वेस्टमेंट कंडीशंस, एमपीसी के असेसमेंट के हिसाब से मैंने जैसे कहा कि 25% इनएडिक्वेट था, लेकिन उसके ऊपर आप करना चाहते हैं तो नेक्स्ट मल्टीपल 50 बेसिस पॉइंट्स शायद थोड़ा ज़्यादा हो जाता है, एक्सेसिव हो जाता। तो इसीलिए एक बैलेंस्ड कॉल लिया गया है। अभी इस मोमेंट में इकोनॉमी का रिक्वायरमेंट क्या है उसको मद्देनजर रखते हुए एमपीसी ने ये फैसला लिया है।
तो जैसे आपने कहा
नहीं, एक प्लीज आई जस्ट कम।
Just, once again, a very basic underlying question on growth. Now, I know, you've talked about the sectoral issues, etc., but growth has come off very, very steeply from 8% 4 quarters ago to now, 5.8% in the last quarter, maybe 5.6%. What is the RBI's underlying understanding of what is happening in the economy? People have talked about structural issues. You don't need me to tell you whether it's income growth, whether it's savings that is proving to be a structural impediment to growth. What is the basic analysis of what is hurting growth right now? Not sectoral, sir, but sort of the underlying issues.
No, as we have already stated in the MPC resolution, which is already put in the public domain, there is a demand and investment slowdown, both put together as, having a sort of a dampening effect on the growth. We have ourselves reduced our growth projection now to 6.9% with risks slightly to the downside. Now, to go into whether it's a structural or a cyclical or it is a momentary thing, that is an aspect which requires a deeper analysis. Our understanding is that at this point, it is perhaps a cyclical slowdown, not really a deep structural slowdown, but nonetheless, we have to recognize that there is room for certain structural reforms which need to be undertaken. But at this point of time, it would appear that it is a cyclical slowdown. And we are still working on it. I think the conclusions, it would be sort of, I mentioned it a little prematurely, but this is our understanding at this point of time.
And urban and rural demand are seeing a hit now, sir? Is it?
Yeah, both urban and rural demand. If you look at it, just to take some examples, urban demand, let's say rural demand in the form of two-wheelers or tractors, or urban demand in the case of symbolized by sales of passenger car, they have slowed down. So there is a slowdown, but we are of the view that it is perhaps counter-cyclical, and with adequate measures taken by all stakeholders, Reserve Bank on its part has done its part, and the government has initiated certain measures. For example, in NBFC sector, in the budget, they have announced a package for first loss guarantee up to 10% in the case of NBFCs. So therefore, I think with measures undertaken, and it should be, we can see therefore, in our own projection also, we have said that in the last quarter, we expect the growth in the current year to be 7.5%.
Governor, where will that...
I'll just come. There was one question here, I'll then come. I'll
Governor,
come to
just
you.
to follow up to
I'll just come to you. There has to be some orderly, yeah.
Okay, Governor, thank you very much. Lata from CNBC. You have given, you said that 50 would still be excessive. But if you looked at the current inflation number at 3.1 and your current repo rate of 5.4, it is still a neutral real rate of 210 basis points. And even if I took the 1 year forward at 3.6 inflation and this 5.4, the difference is 170 to 180 basis points. So what is the real rate you are working with? Do you think that in a cutting cycle, the real rate should be lower, should move towards 125? What is the RBI's thinking? And I must squeeze in the other question, which is so important. What is the Reserve Bank's view on dollar bonds? Are you net for it, net against it?
See, on dollar bonds, I think I have said it earlier also in the press conference in Delhi immediately after our central board meeting, which was attended by the finance minister. We have conveyed our views internally to the government. RBI,
just discussion, sir. Please, can you make your view public?
No, it's like this. The RBI and government, there are so many discussions which take place on various issues, and in this case, especially as the debt manager to the government, our government does consult and is consulting the Reserve Bank. We are conveying our views and we are discussing with the government internally. So for the moment, therefore, I would leave it like at that. I would not like to express my views on this issue this way or that way through the media. Let the discussion move as it is. And with regard to your question about real interest rate, let me say that this is not the